Hey, good morning, friends. Welcome to a Saturday broadcast from BHPH Nation TV. We're putting this out under the Nation TV banner just because we're not in our usual morning show slot. And yesterday's morning show slot was a little bit problematic. And as long as I was having to push, I wanted to give myself more time to pull together some of this subject matter that I want to cover today. So welcome to a live Saturday. I've got some items pre-recorded that we're going to share and kind of do the whiteboarding, and I've got some additional things we can talk about relative to the whiteboard. But today is just another example of the work that I do and that we do in V8 dealer groups, where I'm always working. Folks who've been in our groups and folks who listen to our podcast frequently know that I'm always striving to find new ways to present data to dealers. And so we're always working to, come up with new ways to provide illustrations. Part of that is just that, I'm a very visual learner. And I know that a lot of people that we work with are also visual. So this is partly me kind of working through the numbers as a former dealer myself, thinking about what would I want to see if I were managing a dealership today. What information would I need to get to that would help me to really make better judgments, better decisions? And so today we're going to dive into something I'm going to call pocketable profit. We obviously have a challenge in our business of differentiating between profit and cash flow, and even the difference between an amortization and a traditional contract, or what an amortization might look like versus what we actually collect. So with that, we can go ahead and share the video. I've got, by the way, Michelle's in studio with me today. She's off camera. She's just kind of helping with the background setup. So anybody who's here wants to say hi. Some of the calculations that we have been working with in our V8 dealer groups, and in particular, I'm working to create ways for dealers to better visualize the what's happening in the business, especially as it relates to the rate at which we recover cash, and measuring that against things like our cash and deal and overhead, et cetera. So let me kind of take you through how we will look at that. And I know this on this board is going to be a little bit challenging to see this this particular board until I get a better marker. But we'll start over here with what I call conversion rates. So those that are in our V8 dealer groups, they hear me talk about conversion rates. These are just going to be the percentages at which we have been collecting or charging off. Okay, so this would drive, these might also be called liquidation rates. These are the kind of numbers that drive a collateral recovery rate. They're just simply metrics that would be used to determine the rate at which the portfolio is generating cash, or the rate at which it is charging off. Okay, so that will help drive then the amount of cash flow that can be anticipated on that portfolio, or what you hear me sometimes call portfolio yield. So we have these percentages, and maybe let's say that this first dealer that we would be measuring is collecting principal at a rate of about 3.3%, and maybe they're charging off at a rate of 2.7%. We don't have to get too deep into those calculations today. You can always hop on YouTube and look in our morning show podcast history and find references to CRR or probably conversion rate. So you should be able to find that. But those numbers are going to drive then the portfolio yield, right? Because what it's going to happen is when we project the portfolio dollars, that is going to, because we don't put new contracts in it, we just simply take the amount of the portfolio that we have today. And if we were to project that portfolio as a runoff scenario, to quit putting contracts in that particular portfolio, it will tell us the rate at which we would recover that money. Okay, so when we have that information, I would say, let's look at this. Let's look at it about 12 months out. Let's look at it again at 24 months out, and then at 36. All right. So when we say, this is kind of our projection, then what this helps us begin to think about is, in 20 groups, and I was a member of a 20 group years ago as a dealer. And so kind of knowing how that composite works and some of the math that's been there, I've jokingly said when I was a dealer, back in the 2000s, I used to think in terms of cash and deal, in terms of weeks to break out, right? And then cost of car went up, and now we're talking in terms of months to break out. Or sometimes it would be thought of in other industries, they might call that a months to break even. That's a little confusing because the terminology is not exactly the same. But what 20 groups would typically call a months to breakout is going to be something like this. It's going to basically say, we know what our cash and deal is per contract, and I'm going to run this out to about 12 months because many of our dealers in our V8 dealer groups are running in that range. It varies a lot. I mean, business models vary, of course, but if we call this our cash and deal, okay, after the down payment, then we know that the portfolio is generating cash at this point. Let me pause to make sure that we understand. It's one thing to calculate our months to breakout based on if the customer paid us exactly as expected, right? We can take a typical amortization and say, if this customer paid us $600 a month, this is how long it would take us to recover our months to breakout. That's kind of the way the 20 groups do that. And we do a similar calculation in our V8 dealer groups, okay? So I'm really talking about measuring it in a little bit different way. What we're simply saying is if we think of this as our months to breakout, instead of thinking at $600 a month, how long would it take? I'm asking us to think about at the rate that our portfolio is currently generating cash, because we know we're not going to collect 100% of those $600 payments. So what we begin to do then is say, how long will it take us to recover this cash and deal at the rate that we've been collecting? Okay, so instead of thinking of it on a per contract basis, I'm asking you to think about it on an aggregate basis or on a portfolio basis. In this case, we're taking a portfolio, running it off based on our history, and that's going to tell us, okay, at this rate, at the rate at which we take whatever that dollar amount is at the start of the period, this is our portfolio at the beginning, and we know what we can calculate what the yield is. How long would it take? Like, here's our point right here. How many months in are we? Big question mark right there. How many months is it taking us at the rate that we currently collect cash to get to the place where we have recovered this amount of cash and deal or months to breakout? All right. So this is to recover our cash and deal. Well, when we recover our cash and deal, we have recovered our cost basis, so to speak, the money that we had tied up in the car that we financed. And so we've recovered that cash. That's helpful, but we're not out of the woods yet. We can say that and most of the dealers that we work with, they do think in that way, that we look at recovering that money first, okay? So and by the way, that's principal and interest and anything that we recover in this case. So this also include our repo recoveries, right? This is all part of what we yield on the portfolio that we're bringing in. But we would say, okay, well, if on our typical contract, and I would typically just recommend we have this in an average. So in this example, if we had a $7,500 unit cost and we got a $1,500 down payment, then that might be a $6,000 average cash and deal. All right, just as an example. So we'll now know, okay, the rate at which we're collecting cash, this helps us know that we've now recovered this cash exposure in the contract. But what comes next? Well, we got overhead, right? And even though overhead's been happening all back here, we chose to apply the first amount of cash that came into this cash and deal. So now if we think about what's next, the next bucket would be overhead. Now, I'm not drawing these in proportion because our overhead might actually be higher than our cash and deal. We don't know what that ratio is. Everybody's numbers will be a little bit different. But what's our overhead number? So in order to find that out, we have to know what's our total overhead per month. Take out your owner's salary. That's the way 20 groups have traditionally done it. That's what we do. And this becomes important to think about, what is it costing to operate this business? Overhead is going to be, payroll expense, rent, utilities, all the stuff, advertising, everything it costs to keep that business running. And if we take out our owner's salary just for a minute, we take that number and then we divide it by the number of units sold. So it just depends on the range of period that you're measuring. But if we look at that on a monthly basis, I would recommend using a running average or an average of several months. And now we have our overhead per unit sold. So we would say, okay, at the rate that we're bringing in cash, we recover that. Now we start to apply that next to overhead. So this would be the next question is, when does that happen? How long do we have to collect in order to get to that number there? And you might say, okay, now we're home free. I've collected from the customer enough to recover my costs associated with providing that financing, the risk that I took in the cash in deal in the contract. And now I have a certain amount of overhead per car that I sell. So on this one contract, I now would start to apply the money that I collect at the rate I'm actually collecting it, not what we hope to collect. And we apply that next and we say, okay, now how many months are we out here? That's the next big question mark, is how long would it take us now to get to the place where we've covered both? And this is the number that I'm going to start calling months to profit. All right. Now, this is why I think it's important to really think about that differently. It's because it's both, right? I mean, it's going to be the months to break out of our contract and then the months to break out of our overhead. And I think this will be an important number for us all to get familiar with and think about in the course of our business. I would make the case that we're really not done yet. You know, in order for us to think about all that effort that we put into generating that contract, all the risks that we took in generating that contract. Now we have, we've created a scenario where it doesn't mean that we don't take business or take money out of our business along the way. We're taking a salary which is appropriate. If we're managing the business, then obviously we want to be able to pay ourselves a salary, and that makes sense to put that in overhead from most calculations. In this case, we're removing it. But I would say if we look at just from an operational standpoint, forget my own salary as a dealer, I recover this, I would say I'm still not done. I still have income tax to think about. I would say our sales tax is probably reflected in that overhead number, but you know, I'm not going to include this in months to breakout, but I would just say anytime I'm working with dealers on doing cash flow projections, and especially when we do pro formas for dealers that are new in the business, I will ask them to think about those levels, to think about, and we typically, by the way, when I'm working with them, I kind of do this in reverse order. I think about first recovering the overhead, you know, when we're building a business from scratch. But now, but in this case, if we look at months to break out, our contract first, our overhead next, I would say again, our income tax is another thing that it's an obligation of our business, right? And so we've recovered now our cost of car. We've recovered, we hope, our overhead. And now we have to think about if we apply that income tax per contract sold to this, then can we really agree that we have to get to here before we really have any profit left? So this is the part that I would say, you know, let's start to measure that and really think about what is that math like in my business? We're putting in all this effort. We're taking all this risk on a customer who hasn't shown a lot of financial responsibility in the past, and we're slugging it out, right? Sometimes we're really stressed out because you know, the bank account doesn't exactly match the profit and loss report, and it's kind of being difficult to manage the cash flows. And so that's the nature of our business. I think it's just appropriate for us to pause once in a while and take a look at this kind of math. And so this is the part that we're starting to look at more closely in our V8 environment. And by the way, if you're not a member of our V8 dealer groups, please join us over there. That is something that, you know, we've created an affordable environment. We've created a confidential environment where you can speak to other dealers and you get a chance to see what their numbers look like and have a chance to ask them how they do what they do, especially if their numbers happen to look better than yours, right? So this is part of what we would say, please join us over there, become a member of a V8 dealer group, especially because those folks are going to be seeing some early adopter offers from us on some of our other solutions that are coming to market soon. So you're going to want to be part of a V8 dealer group to have early access to some of those things that are about to roll out. But this is the part I wanted to present today, was to give you a chance to think about when we can measure the actual yield on our portfolio and get comfortable with what that looks like and what we can expect to actually collect, not what the contract looks like, because we know we're going to have losses. And now we can anticipate the yield, and we can begin to ask ourselves, how much is left over for me? Right? This is the idea behind this calculations. What's really left for me after I do all that? And what can I do, of course, to adjust those numbers, to improve those numbers? A lot of levers here, so we can't answer all those here today. And that's obviously part of what we discuss in our meetings over in our V8 groups and our client meetings and the work that I do. But I would say for today, my purpose was in driving home the idea that let's start to think past months to breakout, and let's think months to profit, so that we can make sure we know our overhead per unit sold and think about how much yield do I need on my portfolio so that I can start putting money in my own pocket and know that it's really my money. Because obviously in our business, where the money's moving, the assets are moving, cash is down, inventory's up, inventory's down, receivables are up. It's the nature of the work that we do. And because it's so complex, I think it's important to, hop off the hamster wheel, as we talk about from time to time, take that wide lens and look at the business in a little bit broader way, and make sure that all that effort that you're putting in is really going to produce for you and your family. Okay, so a lot there. And, I recorded that just yesterday, Friday, and, in thinking through that, this is some of the math that we're starting to illustrate. And I think, when we talk about that traditional months to breakout, remember that months to breakout has typically been calculated based on an amortization. We know our risk and deal, we know our average payment, and so we know at our average payment about how long it should take us. The problem is we don't collect all those payments. So I'm asking us to shift kind of the way we look at this math and say, at our rate of converting our portfolio, how long does it really take us to recover that risk? And so that's what this math has been about. One quick clarification: I noticed that I mentioned in there that sales tax may be reflected in those expenses. It really shouldn't be. Sales tax is really a fiduciary thing that's just a pass-through, so it really shouldn't be showing in our expense categories. So sales tax shouldn't be a factor, but income tax clearly would be. And I think timing of income tax is a big thing with us. We're not going to try to get into the whole discussions about related finance companies. I think what we're just really trying to show is globally, operationally, regardless of whether your portfolio lives in your dealership side or your finance company side, globally, this is the rate that our portfolio turns into cash. I didn't use the phrasing back there, but this is what a lot of lenders would call a rolling 12 or a rolling 24, a projection of the yield, a projection of the rate at which the portfolio converts to cash. And that's why I started years ago to call it a conversion rate. But, I think we covered the main points. I had a couple of data points to add for folks who are wanting to kind of back into this math and maybe get a feel for how their own numbers compare. What we're calculating in our regular summary report each month, and this is an actual number through February of 2026. I've got a 6-month rolling average for through February 2026, which says that our groups that have less than 500 accounts, so that's how we break up our V8 groups, is by portfolio size in terms of number of accounts. And then our members who have less than 500 accounts, their average months to breakout based on an amortization and average payment is 10.6 months. And those dealers that have larger portfolios of greater than 500 accounts, that number came out to be 14.4 months. So if you think about that, we've got to collect, and this is based on cash and deal. So the down payment's already in the bank. Now we're looking at our risk in the contract. And if we think about that number, we think we got to collect for that long before we even start to apply money to overhead, in a real simple kind of visual way to think about it. So the next thing we would have to know, and we don't need to dig into that here today, but the next thing we would need to know is, what is our overhead per unit sold? And, I remember from podcast visits from Brent Carmichael in the past, the data I'm thinking of may be back to his days at NCM. But that's an important reason to be part of a V8 dealer group, to be part of a 20 group within IADA, is that kind of information then is in front of you. And I seem to remember that Brent's number for the smaller portfolios back when he met with us before was around $3,600 per unit sold would be operating expenses. So don't hold me to that. You can look that up for yourself. But this is the part that I would say when we stack those numbers together, now we can begin to think about how fast do I really recover those numbers, irrespective of what the average payment is, what my DMS reports might say. Let's shift over to thinking about, how long does it actually take me to recover that profit? One more quick thing, I would ask you to follow our YouTube channel. If you're not already a follower over there or subscriber, please take a moment to subscribe there, because we are going to start to push more of our subject matter through our YouTube channel. And that means you're going to want to get the notifications when we're going live over there. So the best way to do that is just be a subscriber, and you can set your notifications accordingly on YouTube so you can be notified when we're broadcasting live. And of course, you can catch it then as a recording after the fact. But we hope this is useful. Again, look for a lot more of this, and I think you can expect to see us on Saturdays from time to time. We know folks are busy on the move. We had interesting meetings in V8 this month, because between people being busy doing tax refunds and then also spring break, there was it was an interesting thing having smaller meetings and fewer members attending. And so I think this is the nature of it, and people are busy. And so we'll see. Saturdays make sense for us, and perhaps it'll work better for those who are tuning in. So in the meantime, we appreciate you joining in, and hope this content is useful. Be sure to like the video and subscribe on YouTube, and we'll see you back here some Saturday.